Imagine watching a quiet, like super slow-moving currency chart, and then you open up, well, say USD to try the US dollar to Turkish lira.
Oh, yeah, and the price is just violently whipping around within seconds.
Exactly. It's a completely different beast entirely.
Right.
Okay, let's unpack this because today our mission is to do a deep dive into an article on exotic currency pairs.
Yeah, we're really looking at what happens when you leave those safe, heavily trafficked waters of the major pairs.
Right, and just enter the totally volatile world of emerging market currencies to see if they actually belong on your watch list. So, like, what actually pushes a pair into this exotic category anyway?
Well, it really comes down to the ecosystem. I mean, an exotic pair links a major currency, usually the US dollar, with a smaller or emerging economy's currency.
Like the Mexican peso or the South African rand, right?
Exactly. And, they aren't exotic just because they're rare. They're exotic because they operate totally outside those deep liquidity pools.
Right. They don't have that constant institutional participation you see with majors like USD or whatever.
Yeah, precisely. It's a whole different environment.
So liquidity really is the whole game here. I mean, think about it like a superhighway versus a dirt road.
That is a great way to look at it, actually.
Right. Like major pairs are this crowded, smooth superhighway. Thousands of cars, super predictable. But an exotic pair is like a winding dirt road.
Yeah, way fewer cars and sun sharp turns out of nowhere.
Exactly. It's like trying to sell an obscure 17th century antique clock to a local pawn shop instead of selling Taylor Swift tickets to a massive crowd.
What's fascinating here is how that lack of buyers fundamentally changes the market mechanics.
How so? Like with the pawn shop guy?
Yeah, exactly like that. The buyer knows you have very few options, so they lowball you. And Forex, market makers do the exact same thing.
Because the order book depth is just so incredibly thin.
Right. A market maker risks getting stuck holding a totally illiquid asset if, say, a macroeconomic shock hits. So to protect themselves, they widen the spread massively.
Oh, wow. So because you have fewer participants at every price level, even a modest institutional order can just chew through the available liquidity.
Exactly, and that causes the price to gap super aggressively, so your driving skills have to completely shift.
Well, here's where it gets really interesting. Because if the spreads are inherently terrible and the gap risk is that high, why wouldn't a trader just stick to the majors?
That is the big question, right?
Yeah, I mean, if a beginner uses their exact same standard position size on a volatile pair like USD-ZRR as they do on a major, aren't they basically walking straight into a trap?
Oh, it is absolutely a huge trap if you don't adjust your sizing. Leverage just accelerates the losses.
Right, it happens so fast.
Yeah, a lot size that feels totally manageable on a major pair will get you stopped out instantly on an exotic.
Yeah.
It's all because of those algorithmic gap risks.
So is there an actual edge to trading these winding dirt roads, or is this just for, like, adrenaline junkies?
No, there really is an edge, but it comes down to uncorrelated catalysts. Major pairs are dominated by broad global themes, like U.S. Federal Reserve policy.
Oh, I see. So with exotics, you're trading highly specific regional drivers instead.
Exactly. You really have to monitor local inflation shocks, unexpected interest rate hikes, or sudden elections.
And capital controls, right? Stuff that only affects that specific region.
Yes. And if you can accurately model those local developments before the broader market prices them in, the potential upside is significant.
So what does this all mean? It sounds like exotics provide a real opportunity for diversification as long as you respect them.
You definitely have to treat them with respect, yeah. But they aren't all crazy.
Right, because exotic doesn't automatically mean chaotic. Like, look at USD-SGD. The Singapore dollar is traditionally much more controlled than, say, the Mexican peso.
Exactly. The main takeaway is to be incredibly selective. Pick just one or two pairs to study.
And really study those specific regional drivers. Do not just jump in blindly.
Yeah, only deploy capital when the setup and the costs actually align with your strategy.
Right. The smart move is definitely not to chase volatility, but to just trade it when conditions make sense.
Selectivity is absolutely your best defense here. But, I will leave you with this final scenario to mull over, which actually wasn't in our sources.
Oh, okay. What is it?
Well, we know these exotic pairs rely on very thin, localized order flows to function day to day, right?
Right. The winding dirt road with very few cars.
Exactly. So what happens to that liquidity and your ability to exit a trade the moment a sudden, unforeseen global crisis hits?
Oh, wow. Yeah. Like a massive panic.
Right. Like what happens when massive foreign institutions are all forced to pull their capital out of those emerging markets at the exact same second?